Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. In this episode of our Energy and Infrastructure podcast series, we're talking about sustainability-linked bonds and how they're impacting the debt capital markets. I'm Lauren Anderson, a corporate partner in the Houston office, and I'm joined today by Dave Miller and Trevor Lavelle.
Thanks, Lauren. It's great to be here.
Agreed. Thanks for having us.
Both Dave and Trevor are corporate partners in our Houston office with substantial transactional experience representing companies and financial institutions focused on the energy space in a variety of public and private financings and strategic transactions, including lately, in particular, secured and unsecured high-yield debt offerings, complex liability management transactions, initial public offerings, bridge lendings, and loan commitments, and special situations. So with that, let's go ahead and dive in. We're starting to see an increase in the use of sustainability-linked bonds in the debt capital markets space. Dave, can you start by just explaining what a sustainability-linked bond is and how it differs from other bonds?
Thanks, Lauren. So at a high level, it might make sense to take a step back and look at how we got here. In 2018, the International Capital Markets Association published what they call the Green Bond Principles. These created a framework that issuers and their advisors could follow to structure debt products that could qualify as, quote, green. The policy principle behind this framework was really to encourage companies to engage in environmentally friendly projects, and so the use of proceeds from these products is generally limited to current or future green projects. In 2020, the International Capital Markets Association followed up this framework with what they called their Sustainability-Linked Bond Principles. Now, the purpose of these principles are slightly different than the green bond principles. They allowed the creation of debt products whose proceeds would not necessarily be limited to green uses. Rather, they created a structure intended to encourage companies to achieve measurable sustainability or ESG-related objectives as certified by an outside party. Now, coincidentally or not, this framework was actually published at a time when major stakeholders in public and private companies were becoming increasingly focused on achieving ESG-related goals. See, for example, any day of the Wall Street Journal in the past few years. Sustainability-linked debt products generally set forth guidelines that incorporate forward-looking ESG goals, and they're intended to help companies achieve these sustainability goals. As mentioned above, the use of proceeds from these products is not limited to green projects, which means that a far broader set of companies may pursue them as part of their capital stack. Typically, the sustainability-linked framework will provide for one or several key performance indicators which have been vetted by an outside party, and the achievement of which must be then certified, in most cases, by the issuer's independent accountants. Now, interestingly, these key performance indicators may or may not overlap with a company's existing publicly disclosed ESG goals.
Thanks, Dave. And you mentioned that there are, I guess, requirements or criteria that have to be met in order for these bonds to meet this, green bond or sustainability bond categorization. Trevor, maybe you can elaborate on that?
So as Dave was saying before, the International Capital Markets Association came out first with the green bond principles and then in summer of 2020 in the sustainability-linked bond principles. And when they laid them out, they put forth 5 core components that issuers of SLBs should follow. And the first ones, as Dave mentioned earlier, the selection of key performance indicators, is KPIs. And the KPIs, that's kind of the real trick, right? When you're talking about a business that may not be as much in the fairway in terms of green projects, when you're trying to figure out, all right, what are key performance indicators that would be relevant, core, and material to their overall business and would have high strategic significance in terms of their future operations? Something that could be measurable or quantifiable, something that's externally verifiable, something that could be benchmarked against other things. And so it's really about the credibility and the impact of these key performance indicators. So it may not be something you'd necessarily think of as a green project, but something that will have a real impact and is really credible from an objective point of view. So that's the first of the 5 principles. The next one is related, and that's the calibration of the sustainability performance targets, the SPTs. So the SPTs are sort of hand in hand with the KPIs. It's saying, all right, now that you've identified what the key performance indicators should be, what are our targets where we think we can hit them? And they should be very ambitious. That's kind of the idea here, is the company should pick an SPT that is really going to take a lot of work and it's going to make a real impact. And it's going to take some real commitment from the company to reach there. The third principle is the bond characteristics. So this is kind of where the action comes in from an investor perspective. It's great that, they're going to be making these ambitious targets in terms of their performance. But, what happens if they don't hit those targets? Generally, some of the terms of the debt will change. And we can talk about this a little bit more later, Dave and I. But typically, you'll see a coupon step up where the interest rate will start to accrue at a higher rate if they miss their targets. And then there are some kind of related terms that might change based on that kind of flow from the coupon. The fourth principle is reporting. This is something where, all right, if you hit a target, you put it out there, you're going to want to make sure that along the way, you're giving investors information about how it's going, performance in terms of the KPIs, how the company's been doing, assurance report in terms of performance against the SPTs along the way. And this is related to the fifth principle, verification. You're going to want to see a third party who is performing the verification, confirming that the company is achieving or not achieving the SPTs. And typically, you're going to see the company's existing external auditor, their accounting firm, who audits their financials. They'll typically fill this role. They might not be the most enthusiastic participants here, but they're in the best position because they already have a relationship with the company. They have access to the company's books and records. They are guaranteed and required to be independent from the company. And they can really go in there and look at the numbers and say whether the company has hit the target or not. And so it's easy for investors to trust that it's the third-party accountant that is looking at this SPT and gauging whether the company's actually made it or not.
And one interesting dynamic that I'd want to bring up here is that designing these KPIs isn't going to be a discussion just amongst the folks in the C-suite at the issuer or at the borrower. It's going to be a collaborative discussion with their advisors, including their lawyers, their bankers, the folks who are intending to go out to the market and sell this product, as well as the second party opinion provider, which sort of certifies that the framework fits within the framework set out in the sustainability-linked bond framework.
Well, and I have, I guess, one question before we move on. I mean, just to confirm, it sounds like basically if you're going to issue these bonds, you have to establish obviously these key performance indicators, but it doesn't necessarily sound like the proceeds of the bonds themselves have to be used to achieve that goal, just that the goal needs to be achieved, I guess, during the term of the bond. Is that right?
So not necessarily during the term of the bond. There's usually a shorter period during which the KPIs must be met. And if they are not, typically there's a step up in pricing and redemption premium. That means that the design of the KPIs has to be achievable within whatever the period is, 24 months, say. That's, again, where there's going to be a collaboration not only with the company, its advisors, the second party opinion provider, but also the auditors, because the auditors will have to agree that they're able to opine as to whether or not the KPIs have been met. It's not the same as an audit, so the requirements aren't as strict, but it really will become a triangulation of sorts when all of these parties are trying to figure out what the correct KPIs are. And to Trevor's point before, it really has to be something that the market, or at least the second party opinion provider, will deem bold enough or aggressive enough that you're actually achieving something that you wouldn't otherwise achieve. And that's an interesting dynamic when you lay that on top of what other ESG goals, other equity stakeholders may be pushing the company to achieve on a same or similar time frame.
I'd also say that in a way, Lauren really kind of got to the key difference between SLBs and their older sibling, the green bonds, which is activity-based versus performance-based. For green bonds, you do have to put the proceeds towards the project. And for SLBs, you don't have to put the proceeds towards the project right away. You could pay down debt. You could do other things in the meantime, but you have to meet your targets that Dave was just talking about. So that's really the key difference.
And that's an interesting point, because some of these ESG KPIs may not be something that it takes money to achieve. Or it may be, right? If you need to reduce emissions, for example, by X%, it may take investment in the company to improve the equipment that creates those emissions. Alternatively, if there are softer ESG targets that are not necessarily measurable buy a percentage of products that are based on recycled materials or what have you. There may be different aspects that just involve changing the management structure or doing something to that effect as well.
That's really interesting. And it seems like because of the amount of flexibility that companies have in terms of establishing these KPIs, I would think that it makes this a type of bond that could be appealing to a lot of different types of businesses and a lot of different industries. Dave, can you give us a sense of who's going to be likely to pursue this type of bond and why are certain types of companies more likely to be interested?
While there may be a far greater number of companies that could achieve valid KPIs, the market has started to push back a little bit and insisted that these indicators are real and bold and aggressive, and that you're actually achieving something you wouldn't otherwise do. That said, I think you bring up an excellent point. The number of companies that will see this as an attractive alternative to traditional high yield bonds or term loans, I think will expand significantly. Based on the transactions that we've seen year to date, I think there's a tremendous amount of market interest in these products for a number of reasons. While the product itself and sort of the incentive-based performance structure may be inherently attractive to companies, I think the market demand itself has driven very successful marketing outcomes for recent offerings. And so, because I think there are pools of capital which are earmarked for ESG friendly investments, there is a tremendous amount of demand built up for these products. And so, many companies will look to see whether there's any possibility of pursuing one of these offerings just because of market demand. And that in and of itself may drive ESG friendly outcomes. When you have an entire group of companies that are seeking to pursue a financing product which forces ESG friendly outcomes, perhaps in and of itself, that makes it a worthwhile endeavor by the International Capital Markets Association.
And to Dave's point, there are a lot of large institutional investors out there who have made broad, strong, commitments to sustainable investing. And it's easy to come out and say that. And then oftentimes they've been finding there's a lack of eligible financing opportunities to try to meet those goals. And so certainly that's driving some of the market demand. And on the other side of it, though, to Lauren's question, it opens up the door to a lot of different companies, this SLB avenue, but you really have the market's is relying on the second party opinion providers here, of which there are just a handful of these shops, and they've cultivated a lot of credibility by saying, all right, this is an impactful framework. This company is making an ambitious goal. It's credible, and it's not going to be easy to make it. And if they can make to this target, it will have a real impact. And so, for now, that's been good enough for the market. We'll see where this goes in the future, because there are a lot of companies who are probably looking at this and thinking, maybe this is a good opportunity for us.
And you guys mentioned that, the pricing or the interest rate obviously steps up on these bonds if the targets aren't met by a certain date, as set forth in accordance with the terms. I guess the question that I have is, what are the terms, how do they compare, I guess, to, your typical sort of high yield public debt, for instance? Are the terms better, assuming that the KPIs are met?
It's an interesting question because high yield is a market driven product and pricing will be based on demand. And so it's difficult to tell whether necessarily there is an apples to apples comparison to be had here. By adding ESG related features to a bond, the feedback that our clients have given us is that accounts are excited to hear the story. They're excited to be a part of the transaction. And generally speaking, these transactions have been far more oversubscribed than even the bankers selling them have expected. Would the outcomes have been different had these bonds not included ESG related features? Possibly. But I do think that from a company's perspective, both the market enthusiasm that has met many of these offerings in the year to date, as well as this potential preferential pricing that would only step up if they're not able to achieve these ESG goals, has made the product very attractive to a broad range of market participants.
And circling back to the part of Lauren's question about the rest of the covenants, as Dave was saying, it's a really market-driven product, and generally there's a lot of consistency within industry. And so you'll see in a certain space, a lot of the documents will be pretty similar. That is going to remain true here. Generally, the SLBs are going to track basically what a covenant package would look like for a similar issuer in that industry. And in terms of changes to the covenants for the ESG aspects, there's going to be pretty minimal. There's going to be, as we were talking about, the coupon step up that might flow through to optional redemption pricing, equity clause, those sort of things. But it's generally going to look pretty close to what a regular high yield covenant package would look like for an industry participant. And the reporting that we've been talking about, the additional reporting, that's actually not going to show up in the covenants themselves. It's going to be an obligation that the company makes in the offering documents. They're going to promise to update folks along the way. And so it's really just a, kind of stand at their word kind of arrangement.
We're getting short on time. Dave, one last question. Is it safe to say we're going to continue to see more sustainability-linked bonds in the future?
I think the answer is probably yes. I think there may be a bit more focus on what these second-party opinions are certifying as valid KPIs. I think after the first few of these transactions, people started asking a bit more detailed questions in the marketing process about how these goals would differ from the company's regular ESG goals. And to the extent that there's a public company involved, those ESG goals are probably front and center in their 34 Act reports. And so I think there'll probably be a bit more scrutiny on those KPIs. But I do think that given the favorable pricing, given the market enthusiasm for these products that we've seen to date, companies will be encouraged and excited about the possibility of offering these products to the market.
And Trevor, I guess, what's your perspective?
Yeah, I would agree. I would also agree that the market is evolving quickly, as Dave was saying. I mean, it's been less than a year since the principles came out. And each one of these deals is a little bit different than the last. As investors get smarter, as companies get smarter, people ask new questions, and it changes. Sometimes you'll see new terms every time, and so it's evolving quickly. And while it's picking up speed, and there's still a lot of interest, it could evolve in any direction at this point because it's also young. But I think for now, the momentum will continue. I agree.
Dave, Trevor, thanks so much for joining us today to explore this trending topic.
Thank you so much, Lauren, for the time. We really appreciate it.
Yeah, thanks so much for having us. It was a real pleasure.
And thank you to our listeners for checking out this episode of the Energy and Infrastructure Podcast in our Connected with Latham series. Stay tuned for more episodes coming soon where we'll cover other key topics in the evolving energy and infrastructure sector. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about the topics in this podcast, please email us using the links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins, LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins, LLP, and you should not send confidential information to Latham & Watkins, LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins, LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.